As we kick off the discussion today on the big story of the day, we're going live to Malaysia and to Cape Town as markets are in the red and the rand tanks on the back of the oil price war between Saudi Arabia and Russia, as well as the developments of the COVID-19 virus. Now, joining me to unpack more on this is Han Tan, a market analyst, a currency expert at FXTM, and Andre Cilliers, a currency risk specialist and director at Treasury One, coming to us from Cape Town. To start with you, Han Tan, I mean, everything's happening on the world markets this morning. Everything points down. How much worse do you think things could get?
So looking at Brent futures, I think sub $30 a barrel for Brent is becoming a much greater risk now, given the messaging that we're getting out of OPEC Plus, not just in the aftermath of that meeting, but also over the weekend. I think moving forward over the near term, we've got the OPEC monthly report coming out, and it'll be interesting to see because the data in that report will certainly be interpreted with a different lens.
How do you think this is going to play out looking for the next few days or looking at this week? It's going to be a very difficult time for world markets. Well, what do you see the developments happening?
Yeah, so beyond the OPEC monthly report that I mentioned earlier, of course, if you then zoom out, we got to look at central banks. So the ECB is in focus this week, whether or not they will push interest rates further into negative territory, perhaps taking a page out of the Fed's playbook, given that emergency rate cut that we saw last week. So, I think the broader theme here is whether policymakers around the world have enough ammo, not just to offset the economic impact from the coronavirus, but also then for these oil-dependent economies, can their central banks do enough? Because now they are stuck in this trilemma. So it's not just making sure that the yields are attractive enough to keep foreign investors, but also, can they prevent more currency weakness if they ease their respective policy settings, at the same time while keeping in mind their respective growth targets in light of the downside risks.
Well, it does raise the question, Han Tan. I mean, what exactly more can the central banks do? They intervened last week. They ease interest rates in trying to act as a bit of a safety net to what's going on in the markets at the moment. But it doesn't seem to me they've got many more options left.
Yeah, and you've raised a really good point because even after the Fed lowered it by 50 basis points, intra-meeting at that, obviously equity investors paid little heed to that. But I think what Fed Chair Jerome Powell said, I think that that clarion call goes out to policymakers around the world, whereby it's not just an issue to be handled by the monetary side, because that is on the demand side. But what we are also seeing is a supply shock. So can the fiscal side then step in with enough financial incentives or otherwise to make sure that supply is restored as quickly as possible once this coronavirus outbreak either stabilizes or shows meaningful signs of easing?
I can go back to Andre Cilliers in Cape Town, currency risk specialist. What do you think the prospects for the rand this week? I mean, already it's touched 16 to the dollar and 20 to the pound. I'm afraid we've lost him there, so we're going to have to go back to Han Tan, a market analyst of FXTM in Malaysia. So in terms of this whole outbreak as well, I mean, what's the intelligence you're getting on the ground from your region there in the east about how long this is going to be a problem, bearing in mind the damage that SARS did not so many years ago?
Yeah, so keep in mind that if we draw parallels from the SARS outbreak, that was a 6-month phenomenon according to the CDC. Well, this time around, given how highly integrated the global economy is, and also given the makeup of the respective economies, and with China in particular, I think the disruption stands to be greater this time around. Also, if you go back to, say, the fourth quarter or going into 2020, if you look at the global economic conditions at a point in time, this time around, we are coming in amid fragile conditions, amid fragile hopes that the global economy could recover. with the expectations that global trade tensions will be diluted over the coming months. Obviously those expectations have been completely derailed by this coronavirus outbreak. So I don't think there are parallels. I think whatever parallels that could be had with the SARS outbreak some 15 years ago or so, I think that's in the back. I think that's off the table now. I think investors are trying to come to terms with what is still a very, very fluid market environment.
In terms of the sentiment around this big sell-off and the chaos that's going on the world markets, I mean, we're talking in the newsroom this morning saying, tens of thousands of people die around the world from simple influenza. And yet there's not this kind of panic that's going on. What do you think is making this more of a panicked epidemic than the others?
Well, obviously, given the supply disruptions that we're seeing, is evidence of the panic. And also the lockdowns. We just heard how the industrial heartlands of Italy is, travel curbs are being placed on individuals in that region as well. So I think the sentiment is then serving as the basis, or rather the fear is serving as the basis for these measures, and is these measures that are severely cramping global economic activity, not just for economies, but also the fundamentals of corporates all around the world, especially those with a huge global exposure. So it's a myriad of all these factors that are lending itself to this sell-off across various asset classes. But obviously on the other side of the coin, it's proven to be a very, very supportive environment, to say the least, for safe haven assets.
Well, if we just go back to Cape Town for a quick last comment from Andre Cilliers, a currency risk specialist. I say you're likely to be dealing with a lot of worried people this week. What are you going to be telling them in terms of the dangers that lie ahead?
Well, what I'm going to tell them is that this turmoil is by far not over. We can expect further volatility. And in this volatility, there's opportunity and there's threats. And it's rather to focus on the opportunities that arise, but sure to make sure that on the very short term, you are covered and getting some of the volatility out of your income statement by using hedges at this point in time.
And just, looking into the crystal ball about the rand, I mean, we're nearly up to 16 to the dollar now and 20 to the pound. How much further do you think it could fall in this week, bearing in mind all the factors that are at play?
Well, with the rand having reached a level of 16.96 in very, very thin illiquid trade this morning, it's possible that it could see levels of 17 again. And if anything needs to be done by customers at this point in time, they should work it on an order basis and have orders in the market so that it get triggered at the points that they need it to be triggered. But yes, I certainly think that 17 is still a very good possibility. But I also do think that as we go ahead with a week, some sanity will prevail and we would see a little bit more stability coming through as liquidity comes back into the market.
What do you think could bring that situation around?
Well, I think people need to get to grips with the whole coronavirus and the severeness of that virus and not make panic decisions. We've seen it in South Africa this weekend, that people flock to shops and do emergency purchases of all sorts of things. And, the world is not going to come to an end. And one can only appeal to people to stop panicking and not make panic decisions. I think the authorities worldwide is onto the whole situation. I think it's being handled very well by the world markets around, the world leaders all around the globe. And I think people is unnecessarily getting themselves into panic stages at this stage.
Thank you very much indeed. Andre Cilliers, a currency risk specialist and director at Treasury One.